Welcome. I am the Options Overlord, and this is how to trade the cash secured put. This is how you get paid to wait and then buy quality stocks at a price you choose. Income now with a plan to own great companies at a discount. We do it the disciplined way. Let us get to work. First, the ground rules. Everything here is education, not personalized financial advice. Options carry substantial risk. They are not for everyone, and you can lose money. The data I show is believed reliable, but comes with no guarantee. Do your own research, speak to a licensed advisor, and own your decisions. Good, now let us trade. What is a cash secured put? You sell a put at a strike below the current price, and you reserve the cash to buy 100 shares if you are assigned. You collect a premium up front and you keep it no matter what. 3 things make it attractive: a lower risk entry into a stock you want, immediate income, and a defined maximum loss. It is capped, though I will be honest, that cap can still be large. The mechanic. 4 steps. 1. Select a quality stock you would be happy to own at a lower price. 2. Pick a strike below the current price and an expiration 30 to 45 days out. 3. Sell 1 put per 100 shares and collect the premium right away. 4. Reserve the cash, enough to buy 100 shares per contract at the strike. That reserve cash is what makes it cash secured. Let us make it real. XYZ trades at 52. You sell the $50 put 30 days out for $1.50. That is $150 today, yours to keep, and you set aside $5,000 to back it. Your break-even is $48.50, the strike minus the premium. Your maximum loss is $48.50 a share, only if the stock falls all the way to zero. And that premium is about 3% on the cash secured in one 30-day cycle. Notice this $50 strike sits about 4% out, a touch closer than my 5 to 10% sweet spot, so it pays a richer premium. Further out, you trade some premium for a wider buffer, and I am not annualizing that, and neither should you. Payoff. Above $50, the put expires worthless, and you keep the full $150. Your break-even is $48.50. Below it, you are assigned and you carry the stock down, just like any owner. The maximum loss, $4,850, only happens if the stock goes to zero. The premium cushions, it does not protect, so only sell puts on companies you would generally be glad to own. 2 outcomes. Above the strike, the put expires worthless. You keep the premium and the cash frees up for the next cycle. Below the strike, you are assigned 100 shares at 50. You still keep the premium and your effective cost is $48.50. And here is the elegant part. Now that you own the shares, you can start selling covered calls against them. That is the wheel, and it is the next video. When to use it? When you want to own a quality stock at a specific lower price. When the stock is neutral to bullish. When you have the cash and are willing to deploy it. When volatility is elevated, lifting your premium. When you are patient and comfortable holding if assigned. and when you prefer steady income over speculation. That is the profile. The risks, plainly. 1. Your capital is tied up. 100 shares times the strike, locked until expiration or assignment. 2. Assignment risk. The stock can be put to you sometimes early, so be ready to hold. 3. Downside exposure. If it falls hard, the loss can be large, and the premium is a thin cushion. 4. Opportunity cost. If it surges, you keep only the premium. Sell only on quality in an uptrend, and these stay manageable. 6. Best practices. Sell only on stocks you would be happy to own at the strike. Aim for strikes paying 1 to 2% of the cash secured. Aims, not guarantees, and never annualize the cycle. Use 30 to 45 day expirations so the stock has time to come to you. Sell about 5 to 10% out of the money. Delta 0.20 to 0.30 is the sweet spot. Sell into elevated volatility. IV rank 30 to 50 and have an exit plan. Consider closing at 50% of max profit. A level deeper. Delta is your rough probability of assignment and how far the put moves per dollar of stock. 0.15 to 0.20 is very conservative. 0.20 to 0.30 is the sweet spot. 0.30 to 0.40 is more aggressive, and above that you are outside the band. On volatility, you want it elevated. IV rank 30 to 50, and below 30 the premium is too thin. Same stock, a 0.40 delta at IV rank 18, you wait. A 0.25 delta at IV rank 45, that is ideal. Managing it, the 50% rule. Once you've captured half the premium, consider buying it back. You sold for $1.50, it is now 50 cents. You buy to close for $50 and bank $100. That frees the cash and cuts your risk. Then decide, hold to expiry if the stock is safely above the strike, roll down if it is dropped and you do not want assignment yet, or accept assignment if you still want the stock at that price, and then sell covered calls. Rolling a threatened put. 3 moves. Roll down to a lower strike, roll out to a later date, or roll down and out for both. Here is the example. Your $50 put is threatened with the stock at 48. You close it 30 days out and open the 47 put 60 days out for a small net debit of about $30. That buys you a $3 lower strike and 30 more days. Sometimes a small deliberate debit is the right defensive move. 6 mistakes. Do not sell puts on stocks you do not actually want. Do not ignore the trend. Selling into a strong downtrend is dangerous. Do not sell too close to the money. High delta puts get assigned often. Stick to 0.20 to 0.30. Do not forget to reserve the cash. 100 shares per contract. Margin calls are costly. Do not overcommit. Keep a reserve and cap any one name near 25%. And do not panic. Close at a loss. If you wanted the stock at the strike, assignment is the plan, not a failure. Quick glossary. Cash secure put, strike price, premium, expiration, assignment, time decay, implied volatility, and delta. Pause here if you want them to stick. The one to hold on to, you want the stock to stay above your strike, and theta, time decay, is working for you the whole way. So, master the cash secured put. You generate income while you wait to buy quality stocks. You define your risk and choose your own entry price. And you build wealth through consistent, disciplined execution. Educate, discipline, execute. Where to go next? Watch the wool strategy, where this pairs with covered calls into one income loop. Go deeper in the Overlord's covered call playbook. 3 stages, 9 steps, and use code YT100 for $100 off. And stay current with the weekly US market updates. Thank you and good luck with your trading. I am the options Overlord. Educate, discipline, execute.